Deal Surgeons, Elite Masterminds, what's going on? This is Diamond Life, and I'm doing a review for Glitch in the Matrix ranges. Okay, so we have a glitch in the matrix for structure lines, and we have a glitch in the matrix for ranges. Okay, so the ranges are actually more powerful than the structure line, especially on US30. I mean, I literally study. That's why I call this Deal Surgeons, because I break the stuff down like a surgical mission. You know, understanding how US30 worked last summer. I made it like a mission, like a life purpose to really master this and get this down, because this pays out a lot of money for a small account. You know, and Q Banks is another person that only trade US30. So, and a lot of people was scared of this thing. You know, so I had to really understand how it worked, and I'm really proud of my discovery so far to master this. Now, where I messed up was that I thought this was we're talking about ranges, okay? Meaning that before the candle formed on a daily chart, like for instance, right here, this line right here, it means that even though it says Wednesday, July 10th, a new candle formed on a daily chart. If you go to the daily chart at 5 p.m. every single day for indexes, for crypto it's 8 p.m., okay? And for Forex, I believe is 5 p.m. as well, but a new candle formed. So if you understand that, then you can identify the drawn liquidity, okay? So I identified that the drawn liquidity was up here, because even though this still says Wednesday on a daily chart, a new candle is forming at 1800. Does that make, I mean, at 1800. Does that make sense? It stops forming at 5, and then it slows down for an hour, and then it starts back up on indexes. So if you understand the drawn liquidity, meaning that prices are going to take out the previous day's high or low, you can make this a lot easier for yourself. So where I messed up was that with this Fibonacci, I understood that you have a range like this low and this high. Price was working inside of this low and this high. It was working inside of that low and that high before 5 p.m., which is here. So we have to identify the dealer's range, what we call dealer's range with ICT. Okay. And so where I messed up was I actually identified this as the low, the actual low, liquidity low, when it actually was down here. I knew that this was the actual range, but I thought this was what we call a buy range, and I'll explain that. But it didn't retrace past 23.6. So this is what I will know next time. If I think it's a buy range, I need to put the Fibonacci on and see if it retraces past 23.6, because it didn't right here, and it messed me up. Okay, I had to take a loss and then had to get back in and go the opposite way. Now, identifying based on the COT data and ICT imbalances, I understood that this was the structure low. It was more liquidity below this low. I'm sorry, it was more liquidity above this high than this low. And this goes back to the numbers. This is 8.6. See 8.6 right there. And this number up here is 27.3. You see? So that told me that price is going to take out this high up here. It's going to take out this high before it ever takes this low. So this is where Fibonacci becomes golden. Okay. So I put the Fibonacci on here. Now, Fibonacci is powerful to me if you understand where price has to go. Okay. Now, as you can see, price came down here to 23.6. I actually was chasing price on this one. ICT don't do that. But I knew price had to come and take out this high. But I thought maybe it would come down at least 50% or 38.2, or not, depending on Fibonacci, because some people are like, oh, he don't understand the structure. He just depending on Fibonacci. Well, you got it fucked up. I know how the structure works. So we got gaps down here. You got a gap right here that I thought price would fill in. Okay, that made sense to buy it at 38.2, right? Because we got a gap from here to here. Also, we got a gap from here to here. Okay, which would make sense that it would come down here and fill it in at 50%. But that's not what happened. Price just took off at the 23.6. So to be honest with you, I chase price. This is a bad thing to do, because I got in like right here, but price could have easily went back down and tried to fill in this gap, or came to consequent encroachment, which is 50% of this gap. Okay. Or mean threshold. I forget the actual, which one ICT call it. So I hopped in, chased price, and it took out the high up here. It took out the, actually, I was in drawdown because I got in here. I thought it was just going to come up there and take it. Got in drawdown. I still held it because I didn't over leverage. Price came back down. Actually, I didn't know. I was like, damn. I really was in drawdown here, but I didn't get in on that much leverage. So, but I knew it had to take out this high up here. I'm just keeping it real. I did get in here. Where was it? No, I got in right here. So I was in drawdown here, but I'm telling you, I should have waited because we had gaps down here. So price came down here, it looked like to fill in this gap right here that I was showing you earlier, because now price is going to reverse. Okay. So it came down to the 38.2. It came down to 38.2 and 820. It reversed hard and it took out this high up here. You see what I'm saying? What I'm trying to tell you is that even though I was in drawdown because I got in here, I thought price would come up here, but I should have known, looking back at the structure, that it had to fill in at least one of these gaps. Okay, because these are two gaps right here. Okay, we have from this wick, from that wick right there to this wick on this white candle was a gap. So, I should have waited to price to at least fill in this gap, or I should have went long. If anything, I should have went long here because price came down to 50% of this gap from here to here. This is a gap. So it came down to around 50% and took off, but it came back down to fill in the rest of the gap. So that's the way ICT teach it, to get in at consequent encroachment, which is 50%. Okay. So just explaining that. And like I said, price turned around and took off. I was in drawdown, but it took off. Okay. And it took out that high, and then I was out the trade. All this right here, I don't care about, because this would have been guessing. I just got out. I knew where price had to go based on glitch in the matrix ranges, which ICT didn't show me. I don't even think he knows about it. It's something that was shown to me. Okay. From what I call the universe through dedication and never the willingness to never quit, even when nobody's looking. Okay. Some people out there, some of you people watching right now, you tell people you're going to stop. You're never going to stop talking. You talk a good game, but secretly, you know that you're a person that can be stopped. Okay. I was like you in the past, but, for some reason, this is something that, I couldn't be stopped with. So if you look right here, we have another buy range. I'm just explaining this, then I'm going to end the video. Okay. So this is another thing on the daily chart. On the daily chart, a new candle forms. You see, look at the bottom down. It says Tuesday, right? Even though it's Tuesday, right at 5 p.m. at 1800, a new candle starts to form for Wednesday on the daily chart. You have to understand that, because you can identify the draw on liquidity, meaning that price is either gonna this low and this high. This was the high and the low of Tuesday. Let me take a look and make sure. Let's go see where Monday was. Boom. Okay, Monday was here. This low right here, this is powerful. This low and this high, this is the low and high of Tuesday, folks. Okay, I just identified that this is a buy range, because you have a low and you have a high. Yes, price was working inside of this low and this high before 5 p.m., this line right here, but you also have to respect this mini range. This is what I call a buy range. Now, this is what I call the Fibonacci. It retraced past the 23.6 or, hit the 38.2. So this qualified as a buy range. Remember the first one I showed you? It didn't even go past the 23.6. So I shouldn't have looked at that as a buy range. And that's why when I marked it up using COT data, it told me the wrong data. And I thought price would go take out a low that it wasn't scheduled to take based on how this algorithm works. Okay. So if I move the chart to the right slowly, remember, look at this low here and this high. This is what price is working inside of, even though the overall range is this low and this high. But you still can't forget about that low. This is still this low to this high is still what ICT call a dealer's range. Price is going up and down, up and down. It's going to either take out that high or that low first. Well, when I click on this line right here, it says 22.96. And when I click on this line right here, it says 68.16. So which one is going to take? If you watch the video series, it's going to identify whether the liquidity is greater up here or below here. This is very powerful, because based on what I'm seeing, I need to be looking for longs. I need to be looking for longs because price is going to take out this high before it ever takes out this low. But also you have a mini dealer's range. I actually did a video on this very chart right here for Tuesday. I think it was yesterday I did it. What I'm trying to tell you is that you have to understand the ranges. You have to identify liquidity in your own way. I'm never going to show what glitch in the matrix is. It's that powerful. I have something on here called shadow trade, and I'll show you that. I'll show you all ICT stuff that he taught, but this right here is really next level shit. So you have a high and you have a low here. So price is working inside of this high and low, and boop, a new candle forms on a daily chart. So this is still a range that has to be respected, even though it's a mini range. So when I click on this line here, it says 28.56. When I click on this line here, it says 13.43. So which one is it going to take first? Is it going to take this high up here first or this low? It's going to take this low first because the way I do it, it identifies where the liquidity is the strongest based on COT data and ICT imbalances and the way that he teaches the structure. So we see here, price go to the right. We're going to see price take out this low here. We're going to see price take out that low. Boom, right there. Now, once it took that low, I went on ahead and took a buy. Because why? Because I knew, and you may be like, well, why'd you take a buy? How do you know? Because the way that I do this is fail proof. Okay? It's not going to take this lot. I mean, if you have hundreds and hundreds and hundreds and hundreds of case examples of this working, folks, you have to backtest. People don't want to backtest. This is beyond belief. I actually get a kick. I love backtesting. It's like searching for gold. So I knew price would not take out this low. So I went ahead and took a buy here. And then as we see price, the target is where? The target is up here. Because remember, when I looked at the high and the low of this buy range, that's my own word, buy range. Price is inside of this low and this high, yes. But you can't forget about that low right there though. This is still a dealer's range. That this high and this low is still a dealer's range, meaning that at some point it's going to take this low or this high. So just think about that. If you can identify which one it has to take, and you do this hundreds and you got hundreds and hundreds and hundreds of data that is going to take out the higher number, then who can touch you? Okay, so if you take a buy, I took a buy right here, and now when price was coming back down here, if you understand it, and you have a lot of data, quote unquote, you have a lot of data of this not failing, then you wouldn't give a damn about this right here coming down. You would just buy more as long as you didn't over leverage. You're like, it's not going to take out this low. Boom. And it took out this high. Thanks for watching.